Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Wednesday, October 5th. Excuse me, 5:14 p.m. Eastern Time. Coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. State of the market: we're in a correction with a bear market rally going on after a failed undercut of the lows late last week, early this week. Very interesting, very volatile day in the market today. We'll get into it shortly. Check over here at the trend gauge. We have leaders on neutral. Downgraded the arrow from green to black because of some of the action of leading stocks today. One former leader really got taken to the woodshed. It was out of character behavior. It trickled over to an entire sector that was formerly considered a leading sector, and not so much anymore. We'll take a look at that. Meanwhile, the indexes, 4 of the 5, could say 3 of the 5, 3.5 of the 5 major indexes trending below the 21-day exponential moving average. And what I should clarify, mid caps are above, small caps are right on. The large cap indexes, the Dow, the S&P 500, and the NASDAQ 100 are below, were rejected at the 21-day exponential moving average today. Medium term, all 5 indexes are trending below the 50-day moving average, and long term, all 5 trending below their 200-day moving average. As far as what happened today, the color of, I mean, this kind of works like a mood ring, I guess you could say. Who remembers mood rings from the 70s? The color of the comment, the summary: volatile day between support and resistance. Yes, everything listed here is flashing red, but we had a big gap down and then a nice rally. But then we came into resistance and rejected and sold off into the close. So ugly early, really ugly. A lot of stops got hit on our holdings. We gathered ourselves, got back above a key level. We took a couple of steps back into the market, replacing some of the things that got stopped out, because you can't be afraid to do that. If you get stopped and you go back above a key level, you have a choice to sit there and do nothing, or you can make things right. And we'll go through all the trades that we did today. So here's the total: G6 down 0.6%, S&P 500 down 0.2%, was down 1.5% at one point. It was up almost 0.5% at one point. NASDAQ 100 down 0.7%, Dow just barely down 0.1%, mid caps down 0.5, Russell down 0.7, 60/40 diversified global stock bond index down 0.55. GROTECTION down 1.03%. 2 of our holdings got hit pretty hard today. That's really what made up for the lagging number, and then getting stopped and re-entered, although that was pretty much a scratch. But we'll review all that when I get to the charts here. We'll go through the tail of the tape, and we'll go through some charts of interest. But first, let's go through why we do what we do here at Revere Asset Management. And quite simply, this chart here, we've seen friends and family, people close to us, get devastated by pie chart advisors that had no sell discipline. Happened in 2000, happened in 2008, and you just can't accept losses like this when you're entering into retirement. When I found in 2000, after I lost a bunch of money here between 2000 and 2002, thought I was a genius in 1999, not so much by the time 2000, 2001 ended. And I went searching for a system to keep what I made after reading all the propaganda from Wall Street about why you can't time the market. And at the same time as this, I watched my father-in-law, who was dying of cancer, had his money with Morgan Stanley, just got taken to the woodshed, lost half of his retirement. Wasn't a pretty sight when the estate passed to his widow, and don't ever want to see that happen again. I kind of made up my mind then that it would never happen to me. And then when it happened again in 2007 and 2009, my determination was to, at some point, join up with an asset management company that could protect the downside for people. Participate in the upside, protect the downside. I really didn't have much doubt that it could be done, but I knew it wasn't going to be easy. It needed to put some time in, and I spent a lot of time developing the system that we've arrived at today. And what we're doing is we strive to avoid these big, severe losses in bear markets. If you properly get out of the way, you should be down with no worse than a 10 to 12% loss from the highs. That's a far cry from 20% and a further cry from this 44.5%, which is what you get if you're in a severe bear market. We put our rules out there every night in these videos. We talk about when we get in, we talk about when we get out, we talk about our rules for doing that. And if you're interested in that approach, give me a shout. Email me, don@revereasset.com. You can also email dan@revereasset.com. That's my partner, Dan. He's a CFA. He's the master of all things financial. If you call 855-REAL-WEALTH, that's 855-732-5932. You'll talk to Dan. We'll answer any questions that you have. You have friends and family that are not real comfortable right now and are approaching retirement. Give them our contact info. We'd be glad to explain to them why we think they don't have to be slaves to the market. So here's the basic gist of how we do what we do. Back last October, November, the market was trending nicely above all the moving averages, the short-term 21-day green, the medium-term 50-day red line, and the black line, the all-important black line, the 200-day moving average. All of these losses take place once you get below the 200-day moving average without fail. All bear market, there's never been a bear market that didn't first involve a break of the 200-day moving average. So we're in the market as comfortably as we can be for clients, depending on the risk in the market and their risk tolerance. It's a combination of the two, but the risk is primarily with the market. If things start to roll over, we'll get stopped out of our positions very similar to the way we got stopped out today. There'll be paper cuts and whipsaws along the way, but the big trend is what we stick with. If the big trend higher starts to absolutely roll over and fail, you'll break below the 21 and the 50, and the slopes of those lines will roll over. If you get below the 200, this is when you're in risky market territory. We bounced along that up and down during the first quarter of this year, and then we really broke down on 421 when the slope of the 200-day rolled over and we failed to get back above it, and we had a big leg down, rallied off the low. We participated in this. It gave up the market has given up all of those gains since then. We're still slightly off of our lows from down this area, and then we had a failed undercut of recent lows on Monday. We closed at the lows to end the quarter. We had a move up on Monday, a follow through to the upside on Tuesday, right below this short-term average. We got in here, added a little bit more yesterday. We gapped down today, got stopped on some of that, bounced right at the ADMA, and rejected at that all-important 21-day short-term moving average again. So we're battling between the 8 and the 21 right now. We'll see who wins. We don't predict who's going to win. We'll just take action accordingly. We might fake one way and go the other way, and we might suffer another paper cut. But trust me, I don't get concerned about those small losses. A trend takes care of all those losses. And it's been proven over time with our returns. So that's where we are on the S&P 500. Let's go to the NASDAQ 100. Same situation, undercut and reclaimed the 8, didn't quite get up to the 21, but positive closure in the top of the range, and you didn't break down. That's after a 5-6% move up. I consider today to be a win for the bulls, but not absolutely saying ever. There's no absolutes in the market. Not saying that there's no risk. We got above the 21 in the Dow, closed back below it, but again, bounced near this ADMA, the ultra short-term moving average, we'll call it. The slope of the line of that is up, and we're holding the false breakdown level. So what bulls want to see very clearly is a move above today's highs and a move above the 21-day exponential moving average in these big cap indexes. Now let's go to the mid caps. Above it, Second close above it. Didn't break yesterday's lows, so showing some relative strength there. Not on the close relative strength, but all things considered, this has been the strongest of the 5 major averages over the past couple of weeks. Let's go to IWM small caps now. Basically closing right on the 21-day exponential moving average. Did undercut yesterday's lows, did bounce at the 8 EMA, closing right on the 21. All of the slopes of the stochastic and the stochastic moving average are pointing higher. That's a positive for the market. That's the case on the G6 too. So this is why we want to have exposure, but at the same time, we do have our stop. So it's a walking a tightrope between preserving capital and trying to stay in the market. We want to preserve capital above all costs. And now I'll get into what we did in the market today. But first, let's kick off the tail of the tape, see what changed. Still showing, as I said, correction, a bear market rally within the correction. Technicals, the headwinds, no change there. The technicals positive coming off the lows. Put call down to 0.89. VIX actually lower today. When the VIX turned red and the indices turned green, that was a signal to us that not to be as fearful as we were. VIX bounced at the 21-day exponential moving average. Let's look at that level today. You can see we came down, bounced at the 21. Sorry, I've got some allergies that are really flaring up on me today. So holding above the 21 and above that 24 to 26 range, which is kind of considered neutral. Above it is bearish, below it is bullish, but so kind of a mixed bag there, being above the moving averages and above 26, but it is coming down recently, and that coincides with the 3-day rally in the market. Fear and greed at a 31, still under fear. That's improved quite a bit from late last week. We're still operating under the bear case, not a full-fledged rally yet. We need to completely get back above the 21-day exponential moving average. And tomorrow's day 4 on the big cap indexes for a rally. So if we get a follow-through day tomorrow and strength with the leaders, we can flip that from bear case to bull case. Some news today, and the news was positive, which is conversely negative from an inflation standpoint. ADP jobs slightly above average, and they upped last month. When that data came out at 10 o'clock, the market took a turn lower. Also at 10 o'clock, ISM Services Index was strong. That's also not good. OPEC finalized their cut at 2 million barrels a day, despite begging from the administration not to do it. As far as the day count, we're up 2 of the last 3 off the lows. And Friday, we're looking forward to a critical report, the non-farm payroll government jobs report. Coming in today, neutral to positive after the move off of the low. We were weak early, then we rally and faded into the 21. The support and resistance levels for both the S&P and the NASDAQ 100 held, and then we came into this resistance level, 3,800 to 3,815, which failed, unfortunately, and that's when we turned lower into the close. The dollar. One of the reasons for the gap down this morning was the dollar was extremely strong. Let's look at a 5-minute. The dollar weakened throughout the day. The dollar weakening coincided with the positive reversal in the markets. Market is totally at the mercy of the dollar right now, which is unfortunate. So we're paying a lot of attention to what's going on with the dollar chart. Oil's strong again today off of the back of that production cut. Semiconductors were strong and software was strong, which gave tech a little bit of a bounce. Tesla continues to be the biggest laggard of the big caps, as this Twitter Musk deal is a distraction to Tesla, and also they missed on their deliveries for the last quarter, even though it was their highest all-time delivery. So we're looking for any strength in Tesla, and it's into, you can see this area here provided some support back here in May, June. Sorry, it was resistance back here in May, June, and July. We broke above it, but now we're trolling that level again around the 240-ish level. This This level really needs to hold to get the NASDAQ 100 above the 21-day exponential moving average. On the other hand, Apple finished positive today. What we see right here, this is really what we want the indexes to do. If this was the 21 EMA instead of the 8 EMA, so Apple accomplished that at least today, getting above the 8 with a positive outside reversal. It means it made a lower low and a higher high. That's a bullish pattern. On the downside, bonds down, which meant rates were up. That doesn't help the market either. And now the sector that really got taken apart. Enphase, former leader of solar, was down almost 13% at one point, undercut all recent levels of support. Started out weak during the day, as did our biggest position, which was First Solar. And naturally, First Solar failed its breakout pretty miserably here. As you can see, this 140 level was the breakout. We held it yesterday, closed near the top of the range, broke 140 like a hot knife through butter. I mean, there was no support whatsoever on this 140 candle. Obviously, a bunch of stops below that. They got hit. Sometimes they hit them, and then it goes right back above. That's what I was looking for. That wasn't what I got. So we stopped out of our entire position in First Solar. A small loss on the second buy, a tiny gain on a tiny loss on both of them. But the net was only negative 0.15 of total AUM, still below our threshold that we don't want to lose more than 0.2 AM on any trade. So again, a reminder, when we re-enter the market, if we take 5 trades and we risk 0.2% on all of them, and we get stopped out on all of them, we're only risking 1% overall to the portfolio. These re-entries into the market don't come risk-free. Nothing ever does in the market come risk-free, but over time, this is what we've come to realize is a good risk control metric. Note First Solar did bounce right at the 21-day exponential moving average, but the negative action in the entire sector today and in Enphase led me to just not want to play around. I mean, this looks terrible. This chart of the overall sector doesn't look anywhere near as good as Enphase and First Solar did as they were holding up. But the weight of the sector overtook the strength of those two individual leaders, so we got stopped out of that. Moving on, gold, silver, and gold and silver stocks were weak today, but they did rally into the close. Again, the gap down in them was because of the gap up in the dollar, and then as the dollar came off, these stocks trended higher on the day, and actually a pretty darn good close on GDX, undercut and reclaimed the 50-day moving average. I was looking at this close today, just didn't decide to take the trade. Silver, also at the top of its range, bounced at the 8 EMA, a very good close for that, and the yellow metal itself below the 50-day moving average, but again closing at the top of this range. And this is also moving directly opposite to what the dollar's doing. Housing mortgages were down 14% year over year. ITB builders were weak, and XLRE was weak. XLRE just continues to be one of the weakest subsectors within the S&P 500. Look at that broad sell-off last week, anemic bounce on it. So focus coming into today was the positions that we had. Could we add to them? They were the leaders, and any new leaders that were holding up. I mentioned Wolf yesterday, and I mentioned Vertex. Vertex finished positive. We took a position in Wolf. I'll talk about that momentarily. And then also watching the indexes into the declining 21. Well, it appeared early that the fact that they even got close yesterday, they weren't going to get close again. And our stop out on the UPRO and SPXL combination as we started to go lower resulted in a small positive gain for our trip into the indexes. UPRO was bought in the 3600s. The 3700s, 3770 was where, 3770 was where we got into this XPXL position yesterday. So we gapped below that. So we're immediately on alert that we might get stopped out of that. And in fact, that we did, to preserve the gain between the two of them. But Then we undercut the 3830-ish, sorry, 3730-ish level. Let's take a look at this, and you can see back to the S&P 500. So here, this is the area that I've been showing as a support level. Let me move this up a little bit to make sure that it's there. So this 3715 to 3730 level. Got down to 37.22, stopped out of the rest of it for a small gain, and then we started to bounce. Also bounced at the ADMA, so came to the realization I was a little premature on getting rid of that last part of it. And when we formed this intraday cup and handle, this is a 5-minute chart of the S&P. You can see the cup and handle. This would be considered a low handle. We popped above there on higher volume. This is accumulation. Then we had another handle and popped above there, and that took us back up to the 3730 area, and this is where I re-entered, but this time using VOO, a single ETF. We did two 15% buys on that. So we came in with the equivalent of 39%, 38, 39% using the triple ETFs. We were leaving the day with a 30%, and we closed. We have a small profit on this. We got back in right at around 37.70, 37.72. So we've got a small profit on that. Let's take a look at the rest of the charts in detail, the changes that we made. So early, right out of the box, lithium was a big laggard. LTHM. Now note we bought this on this big shakeout on a downgrade. Got it when it went back above the 50. Everything looking good. Yesterday it got above the 21, but had a weak close. So a little bit of a yellow flag there, and then gap down, and then through the 50-day moving average like it wasn't even there. And then we got stopped. Here you can see the breakdown below there. It did rally later in the day, but still closing below the 50-day moving average. So 0.1% loss on this lithium. Actually, it was 0.08. It was only a 2% position. So the 0.2 is typically if we do a first buy and then a second buy. So 0.10 on a 2% position, got stopped on that. Then I already talked about First Solar. I talked about UPRO and SPXL. I talked about rebuying, re-entering VOO. When we started rallying after we bought VOO, this had been on my list. MTB, by far the strongest of the bank stocks. And you're going to say, Don, why are you buying a bank? That's not going to do double what the S&P 500 return does. Well, here's MTB over the last year, up 20.8%. Here's the S&P 500 over the last year, down 13%. And just for comparison, let's put in Bank of America, down 30%. So yes, MTB can absolutely do double what the S&P 500 is. This is, if you look on a weekly chart, it's much better looking consolidation. Tight here, a double bottom on top of this. Relative strength at a new high. You can't look for much more. And with the inside day today, the volume was light early. A little bit of volume came in toward the close, but inside day on the second day up, we bought 3% size twice on that, so we have 6% in MTB. And then I bought Wolf near the close, WOLF, bounced at the 21 day just like we needed it to. Very easy stop out, and then we added to CEG, so we have a 5% position in CEG now, as this showed relative strength for the most part today, relative to some of the other leaders we were looking at, bounced where it needed to at the 21, and then when we got back to our quarter to a half of an ATR within the initial buy, we put the rest of the position on. So going out of here, we own MTB, we own Wolf, we still own CF. We haven't pyramided this yet, as this is just kind of hanging around, sitting on the 50-day moving average with the 21 turning to come back up through the 50. And then we've got the 30% VOO position now. So coming in today, 0.62 on our adjusted beta going out was 0.57, so basically 57% of the risk of the S&P 500. So bottom line for today, gap down, bounce at support, rally, rejected at the 21. So we're playing ping pong between resistance and support, and we need to see what happens the rest of the week leading into the big jobs report on Friday. So those are the moves. A couple stocks that are holding up very well that also have my attention. Vertex. This couldn't look better with the action over the last 3 days. Paylocity, PCTY, very nice move today with relative strength at a new high. This is probably the leading software stock, certainly from a liquidity standpoint. Yeah, it only trades $374 a day, but it's a $260 stock, so it's right there near the liquidity that we would need. Exxon would have been a fantastic buy off the 200-day moving average, coming up into this 100 area now. Relative strength at a new high, big move higher with volume for Exxon today. Trying to sneak into oil somewhere with, but I never like buying on the third day up, anything on the third day up, and we'll see, hoping for a little bit of a flag here in some of the oil stocks to give a good entry. I talked about how Enphase got hammered today. LNG had a nice day today. This is another one that we're considering, and this really hasn't, this has been tight for the last 3 days. So this is probably number one on the list as far as oil and gas stocks for what to buy. Look at all the blue bars there. It's been up 7 straight days after the shakeout lower a week and a half ago. Let's see what else had significant moves today. So bottom line is we got caught in 2 of our holdings had above average losses today, lithium and First Solar. That accounted for the losses on the day. Here's BJ's breaking the 50-day moving average. This was a leader as retail stocks continue to get weak. I was looking at CMG and how it bounced at the 200-day moving average. That needs to hold the 200-day moving average. There's a couple of big stocks that we're keeping an eye on as really a finger on the pulse of the overall economy, and the leading retail stocks is where you want to look. But if you look at Costco, things aren't looking so good there. Low cost leader, you think that money would flow to what's weak. Dollar Tree, another example. So money would flow to where the prices are lower, but these have been acting weak. Dollar Tree, also Dollar General, these held up for a while. This is probably the best looking chart here. Dollar General showing some relative strength, but not last week, as retail got hit last week. So that's where we stand, and that's going to wrap it up. As always, love to hear from you. Email don@revereasset.com or phone 855-REAL-WEALTH. That's 855-732-5932. So reminder, it's not how much you make in the market, it's how much of that you can keep. That's why we say we take care of the downside first. Risk management is our number one job. We might get a couple of paper cuts along the way trying to participate in the market as it attempts to right itself, but you get one good trend that pays for all of those paper cuts. And if you don't believe me, Google Ed Seykota Whipsaw Song. He's one of the all-time great traders, and also a banjo player, and has a band, and the Whipsaw Song is very entertaining, so check that out. Ed Seykota, Seykota, Whipsaw Song. And with that, I'm going to wrap up Wednesday, September 5th. This is Don Vandenbord telling it like it is. Thanks for listening and have a great day.